Francis Donald is chief economist at Manulife Investment Management, and with us. And Francis, we knew, of course, that although it was delayed, we would get these next couple of regions in Ontario to the next stage of reopening. But I do want to kind of check in with you on, as we get closer to normal, and yet we see other jurisdictions with a pop in COVID numbers, what's your thinking about how you price in what that new normal might look like, or at least this interim phase?
I think you've highlighted one of the key problems here, which is we can reopen our economy, but are people going to use it? And this comes down to confidence measures. Are we actually going to see a pop in consumer confidence, which is at 2008 lows? Are we going to see business confidence, which is at 2008 lows, really rev up as the economy reopens? And what are we going to do about childcare? StatsCan released a report today saying 90% of households who have children under the age of 14 are not using childcare right now, compared to 40% before. There are still a lot of limitations to how this economy is going to work, even if we say stores can be opened.
A lot of limitations and a lot of risks, of course, ahead. We still have a lot of government support in place for businesses, and we've seen extensions of that, Francis. As we look at some of the data that's come in, and I'm talking here about that very strong pop in retail sales that was more V-shaped than we might have expected. Although, of course, there's always nuance in the data. And we're looking at the second quarter numbers rolling in for various companies, and similarly, we see the bounce off the low that gives us reason for optimism, and then the fear about what happens next. So we've talked a lot about the shape of the recovery, if you will. How much of it will depend on what governments do here? We've got the U.S. contemplating new stimulus, our government, of course, changing a little bit, but maintaining programs. How important is the fiscal role here?
It's huge. And we do have a big Fed meeting today where they're going to make an interest rate decision. Of course, they're probably not going to change any of their main policies, but we are seeing this monumental shift away from central banking being the main driver of market sentiment and towards fiscal. In the United States, a lot of concern about the expiration of the $600 per week unemployment insurance top up. That expired last weekend. Now we're moving probably to a system that has much less of a top up. Canada will likely go down that road eventually as well. That's been the primary support behind this reopening. And if it disappears and it's not matched by a surge in confidence and rehiring, then this economy moves from what we called phase one, the rapid rebound, into what we're calling phase two, the stall out. And the closer and closer we get to the expiration of more benefits, the more concerned we're going to be. So you're right. It's all about government stimulus right now, providing enough to keep the recovery going and making sure incentives are in line.
We do have, of course, the Federal Reserve today, and we'll get an announcement. Like our central bank, we don't expect anything on the overnight lending rate, that headline rate. But we do expect Jay Powell to make some comments about where he sees the economy, where their concerns are, right? The language around their confidence or level of optimism about a rebound here. What are you looking for from the Fed today, just in terms of what you think we might hear or what we want to hear about where the U.S. economy is going?
Well, Chair Powell has a very difficult job at hand. He's told us repeatedly we're in learning mode. We have to wait for a couple months to see what's going on. But he cannot just rest on his laurels today. He has to express that they'll do more if needed. And that may involve some reference to yield curve control. It might involve some reference to outcome-based forward guidance. That is, they try to tilt the statement away from just we're going to keep low rates for a long time towards tying it towards a specific outcome, like inflation at 2%. He has to at least allude to these developments, or else he risks a spike up in rates, which is the last thing this market needs right now. This market already a little bit nervous, particularly compared to a couple of weeks ago. Chair Powell has a big job ahead of him today. We'll see how he performs.
Let's talk about that notion of trying to control the curve, taking a more active stance, because so far, Francis, it feels as both the U.S. Federal Reserve and our central bank keep saying we're not going to do that, but they say it in a way where they keep mentioning it. In other words, it is a tool that they have on the shelf. They're not saying it doesn't exist. What would it mean in a practical way for investors who hear this, yield curve control? What do we mean by that? What are the practical implications of it?
Well, central banks typically like to focus on the front end of the yield curve. So 2 to 3 years for Canada and the United States is really where they're the most effective at controlling rates. But increasingly, there's this larger problem, which is governments are issuing huge amounts of debt at the longer tenures, up to the 30-year tenure. There's a lot of issuance there. So central banks are faced with a situation, which is that we have rates at the long end that are starting to climb that can dampen growth. So even if they say, no, we're focused on the front end and we'll use things like yield curve control, we know that there's going to be this active need to make sure the yield curve doesn't steepen too much. Now, if they're successful, it means they have to start buying things that are further out the yield curve maturity. The Bank of Canada is already doing this, buying more 30 years than they were before, but there's going to be a lot more talk about this curve, particularly as we see more government spending that lifts the back end. I really believe, you and I have talked about this before, that line of independence between central banks and governments is getting really blurry here. What they do is largely influenced by each other, particularly low rates giving permission, in essence, to governments to spend a lot more than they would have otherwise.
Yes, no doubt about that. And just in terms of any signaling on the front, I mean, I think we've already said that what we expect to hear is that the importance of fiscal is still there. In other words, if there's any messaging around fiscal spending from the Fed, it's going to be not to withdraw it, not to be hawkish on it.
Well, that's true. And Powell knows he's not technically supposed to say anything about fiscal policy, but he's going to make references to the fact that monetary policy is a blunt tool. Yeah, they can change rates, they can buy purchases, but that's not going to keep companies from going under. It's not going to encourage rehiring en masse. That has to be government spending. So there's a lot of tricky ways Powell can go about this. In a way, we know the more government spending we get, the less central banks have to do, and vice versa. So definitely Chair Powell going to bed every night, hoping we get an extension on those unemployment insurance benefits. And I'm sure Governor Macklem here in Canada is doing the same.
It's interesting, every now and then you get these great charts showing how wrong market participants generally are about the Fed. In fact, most of the time they're more hawkish than the Fed winds up being, at least in recent times. How much of that plays into the U.S. dollar, and what's your thinking about strength of the U.S. dollar? Because for a lot of, for instance, gold investors, that's been a major factor recently. But where are you thinking on the U.S. currency?
A weaker U.S. dollar makes sense to us in this environment. It has moved very quickly, so it doesn't mean you can't get a pause in that. That is consistent with a weaker U.S. dollar and, of course, stronger gold price.
All right, Frances, always great to have you with us. Appreciate